Morning, everybody. It's Chris here from Serene Education. It's the last week before Christmas, so the 19th of December 2016. Just looking at some data. What one needs to do is get a gauge of the prior week to see what's been moving. We obviously want to try and set up or strategize our following week ahead. And what we need to do is look at previously what's happened in the previous week to give us an understanding of what's likely to happen in the following week, so this week. So over this weekend, one would have looked at the closed market, so Friday evening close, open your charts on a Saturday or a Sunday before the Sunday evening open, and then look to see what's happened over the prior week. So what I tend to do is to use a volatility calculator to see how much volume we've seen over the prior week, and that would then give me a bias or a rough idea of what pairs have moved, and subsequently those are the ones I'm going to look to continue to see if there's any continued movement within this week. So what I've done is I've used a tool and I've calculated the volatility over the previous week, so 1 week's worth of data. And this puts out all these crosses. So some of these are really US dollar Mexican, US dollar ruble, some serious movement. US dollar South African rand is another one with some serious movement. Those ones you tend to stay away from because the volatility and yeah, it'll just kill your. But you want to focus on the 22 majors in particular. Out of those, you get the 4 majors, and you get the crosses, the end crosses, etc. But notice, just look and see which pairs have moved substantially compared to the overall bias. You can see over here CAD Swiss franc only moved 61 pips in total, so only 0.79% of a move the entire week. Having said that, that could be quite a lot for that particular pair. But ideally what you want to see is continued volume. We need volume. We need to see momentum, and momentum is going to be directional. I would ideally like to be directional to paint strong positive or negative trends. So I've looked at the ones that have pretty much moved the most, and you can see that the pound crosses in particular have really stood out, and have stood out since Brexit, in fact. But you'll notice that here, pound New Zealand dollar is a good example of that one. And I'm going to concentrate on the pound New Zealand dollar because out of all of them, it has been the one which has moved the most. So here, 230 odd pips for the entire week on average, and that's a 1.31% average for that particular week for this cross. So now that I know which ones have moved the most, I can look at these ones and say, great, if there is a major move like pound New Zealand dollar, which other crosses would have a positive or negative correlation with the pound New Zealand dollar? So therefore I'm doing more more in-depth analysis to then fine-tune which ones are genuinely moving and have genuinely moved consistently with the pound New Zealand dollar. And here again I've used a similar template, and there again I've looked at how much pound New Zealand dollar has moved over the last 25 hours, in fact. So on a time frame here, an hourly time frame, I picked a period of 25 particular, in this time 25, so 25 hours of data to see which ones have been moving with a positive correlation with the pound New Zealand dollar and with a negative correlation against the New Zealand dollar. So straight away I've got 3 that have a strong correlation of 0.9 or higher. So I'm looking for those with a higher, above the 0.9% and higher towards a 1% level. So you can see how the euro New Zealand dollar is quite strong. But that's the case though. I mean, if pound New Zealand if pound itself is moving quite strongly, then the euro tends to move quite strongly with the pound. In this case, you can see the base currency, pound, euro against the New Zealand dollar, and you can see there's a 90%, 0.9% correlation between the two, and you can see the graph of here. So here's pound New Zealand dollar plotted over the last 25 hours of trading, and you can see the euro New Zealand dollar pretty much doing exactly the same. And there again, you'll notice on the you also notice that over here we also have pound Australian dollar. So New Zealand, Australia, also quite close in terms of their trading, etc. like that. The trades, big trading partners like the euro against the pounders. So therefore, if the New Zealand dollar is seeing some negativity or positiveness, that should be reflected in the Australian market as well. So here again, you can clearly see off the bat, I should be looking at euro against New Zealand dollar because it's got a strong correlation with the pound New Zealand dollar. Pound Australian dollar, strong correlation with the pound New Zealand dollar, and the euro against the Australian dollar has also got. So straight away I can look at these for opportunities, and vice versa. The ones that have a negative correlation with the pound New Zealand dollar are Australian CAD, both commodity crosses. Here 0.93, so above that 90 threshold. Australian Swiss franc, another one. Australian US dollar, the New Zealand US dollar, and the New Zealand Japanese yen. These are all above that threshold of 90 or higher. So there we go. If I can just zoom in here, just to bring it up. There we go. So 95. So there again, all I'm going to do is concentrate all my time on those particular pairs. Not really interested in anything else because there's not that much volume. Great. So what I do then is I bring up my MT4 platform. Now, made a note of all these ones. Bring up my MT4 platform now. Now I can concentrate. So here you can clearly see at the bottom, I've got a number of pairs. But the one I'm going to reflect on is that pound Canadian dollar cross. Okay, which is right down the bottom of here. Clearly seen. So as an example. So straight away what we do is we look at the monthly time frame. And straight off the bat, you can see that last month's candle was very negative indeed. Nice bearish engulfing candle there. You can see over the last 1, 2, 3, 4, 5, 6, 7 months prior to that, you can see a lot of bullish momentum coming into this particular pair. Australian dollar really climbing really aggressively against Canadian dollar, and that was primarily to do with weak data coming out. Well, weak oil data, because remember you got to look at both parties here. Australian dollar is a commodity pair, but a mineral, iron ore, gold producer, etc. So more on the mining side. And you look at the Canadian market, also Canada primarily an oil and gas producer. So therefore, if you see Australian dollar doing well, it's primarily to do with predominantly its mining sector. So through that period, you can see a lot of movement to the upside, and you can see the oil Canadian dollar which is based on an oil producing nation, relies heavily on GDP in terms of oil production and exportation, and you can see a very low oil price hasn't done well for this for the Canadian dollar overall over the last couple of years, and that's reflective in price action. So here clearly moving to the upside. Australian dollar also has a higher interest rate compared to the Canadian dollar at 0.5%. So here again, carry trades, etc., would be far more lucrative. So here you can see bearish engulfing candle, and this bearish engulfing candle here was predominantly brought about because of what OPEC did at the announcement of OPEC and oil production cuts in oil production. That has made it quite scarce. It's driven the price of oil up. And if you think of Australia, a big mining sector, mining service industry needs a lot of oil in terms of logistics, etc. Clearly, higher oil prices is not going to do well for a mining corporation, because they have to then have to pay more for the oil because they need it as a major part of the mining services. So that's clearly had a negative impact, and sure enough, we've seen prices driving low because of that. So now you can see this month, going to December, we can see because of the creation of that very, very negative prior month, you can see that we should have been looking for further selling because of the actual creation of this bearish engulfing candle there, engulfing the prior month and a half of data. Pretty much, it actually fell all the way back to a prior resistance level high, which were these levels here back in, you're looking at July, August of this year. So we should have been looking for further selling, and if you're going to look for potential selling, where's our next likely target? Well, straight off the bat here, you can see we could be heading towards this level over here, which is the June level of 2016 as a potential target. And if you look at it, we are pretty much within a potential channel. So the low in 2015, the high in 2015, back down to the low in 2016, the resistance level high in 2016. So you can see here we've got two valid points. So channel bound. So effectively question mark, where's our likely target? We could be looking towards this level over here as we head into 2016, the end of 2016, 2017, the start of 2017. So in and around this area here would be a viable target. And vice versa, what you could do is also take a fib retracement, because remember, price has been moving up aggressively. She's now pulling back. question mark is how far the pullback's likely to go. We can always go back to 100% or back to 0, which is back down here. So what we can do is then calculate how far all those levels. So there again, just plot that on. So lowest point to the highest point, and you can see 0 is always your start. Your highest point is 100%, and now you can see that price has pulled back past the 78.6, way past the 61.8, headed down to the 50%, which is 50% of the entire move, and vice versa. Now you can see we're trading at that 38.2 level. So what I'm interested in now is if we are to see further continued selling, and as we rightly said, we could see the bottom, which happens to be the 23.6, funny enough. But now this is the important part over here. You can see that price is trading in and around this area, and potential people would be looking to target this level as a potential target, TP level. Now we're trading around those levels. What we could expect to see is a consolidation, and rightly so. You can see price right now, when we drop down to the weekly, you can see that we saw further selling, a major pullback at the start of the week, but selling coming back into it. And last week's closed lower than 38.2 level. Great. So now if we are to see any further opportunities with selling sentiment, i.e. back towards that trend, the channel low here, around about this level here, which happens to be the 23.6, we should be looking for a continuation. So you can see right now, closed low. So far, Sunday evening's open and going into Monday, we've seen a slight consolidation, a pullback to retest the underside of 38.2. So now looking at the rest of this week, what we want to see is further selling coming in, further selling pressure on Australian dollar, and further strength in the Canadian loonie price. So here again on the daily, what we can do is drop down. You can see now Sunday evening opening lower and moving high going into the start of Monday. So for the remainder of this week, what we want to see is further selling with sentiment, because we've seen that price is driving low again. Perfect. Let's look to see if we can see continuations, i.e. if you want to be more passive, wait for the daily candle close lower than the Sunday low to then give you a swing low creation, and then you can enter, and then your target would be the 23.6 level as a viable target. Or you could drop down more aggressively to a 4-hour time frame. Here we go. You can see the 4-hour price is pulled back over, well, started low on the Sunday evening, then pulled back to the underside. And what we want to see now is a bearish engulfing candle, a shooting star, a hangman, etc. You can see already that we're starting to see signs of negative sentiment coming into the market. What we want to see, though, however, is a bearish engulfing candle to confirm that continuation, that negative continuation is coming in at the underside of the 38.2 level, and then we can target the 23.6. So now, if you look from the 38 to the 23.6 fib level, is about 150 odd pips. We're not going to get all that, because if you're looking for a bearish engulfing candle, it might close, and it would ideally like to close below the Sunday low, which is around here at 97.06. So take that level to that level over there. You're looking at 130. Be happy with 100 pips. Guaranteed 100 pips of movement here. So here again, just be patient. What you can do now is look for to apply things like a box breakout pattern. So if I just go and apply that onto the chart quickly, I've applied the box breakout now. Okay, so what we have to do now is, if we're looking for further selling, we need to see price breaking lower than the box, this creation here, which has taken the Asian high and Asian low and boxed it. I've taken into consideration the 8 a.m. GMT start, which incorporates both the European start as well as the UK start. So we have a lot of volatility. It's the most liquid part, volatile, most liquid part of the trading day. So what we want to see is a continuation breakout. So now if I want to be even super aggressive, drop down to my 1-hour time frame, and what I'm looking for is a bearish engulfing candle close, a nice full-bodied bear candle, very little wick, so telling me or informing me that there's less indecisiveness and more directional decisive movement on that. So that's what I want, and you can see the outcome over here, 40 odd great pips on that breakout over here. There again, another breakout over here, and 30 odd pips on that one. So here, clearly I want to see a breakout of this level over here. So what I can do now is I can apply a trigger alert. So take my trend line alert, draw a line, try and make it as straight as possible. Perfect. Right click on it, go to trend line alert. I don't want to do that. I want to write in here trigger. Oh, if I could spell trigger cell in this case. Copy, paste in the description. So now I've added what I want to see from this. Just take it to the underside of this box. Great. Then I want to apply the trigger alert mechanism. So here, drag my custom trendline alert indicator onto the chart. This is what you end up having. Go to common, make sure they're all ticked. If you're using an email alert system, say yes. If you're not, then false. I'm in front of my computer, so there's no need for me to see that. All I want to be alerted is on the close below that trend line. So this yellow line over here, I need to see a close below that, and then it'll pop up. A box will come up and it'll bleep and all that type of thing. I want to keep the color. No, you don't need to change all that. Click OK. So now what I have in the chart now is I've applied a trigger alert, this little yellow horizontal line, at the underside of this box, because my whole process, this just by looking at this particular pair, is I've seen selling pressure on my monthly, I've seen continued selling on the weekly, the prior weeks heading into this week. So we're trading below a major fib level. Check, 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 all checking selling sentiment. Great. I want to see a continuation of that selling pressure. Fantastic. What do I need to see? And what I'm looking for is a close, price to close lower than this box on a 1 hour time frame. And only then, if that candle is bearish engulfing and with little wick whatsoever, so a nice genuine directional candle with the selling pressure, then I'd look to enter, and ideally my stop could be above the box breakout, so I know what my risk is likely to be. Essentially 24 pips. Depending on how far the 1 hour candle is closed, we could be looking in excess of 50 odd pips on average, and I know where my next target is. It's a good 100 pips below, so my risk to reward is 2 to 1 or greater. So in this case, ticking all the boxes in terms of the entry sentiment wise, risk sentiment wise, etc. So fantastic. So all you have to do now, once you've done all this, is to sit back, be patient, and wait for price to do its thing. If she doesn't break lower than the box, and she doesn't trade lower all day, you wouldn't have been triggered in prematurely, and you wouldn't be trading at a loss. Because remember, we want to trade trend direction. In order to have a strong trend continuation, we need volume. Hence, wait for the big boys to come back into the market again. Wait to see that selling sentiment coming back in again. If we do get it, it will move price low, as expected, to the downside. A nice bearish engulfing candle is what we want. So ticking all those boxes mechanically, and only then do we look for an entry, and we know where our target is, which is the 23.6. We know what essentially profit-wise we're able to get from this. And then you just pull the trigger. Very mechanical in your approach. I hope that's helped.